Hi, this is John Kamarianos. Welcome to a new edition of Capital Considered. Morningstar has a new retirement report out, and their official number is 3.9%. That means a new retiree can take 3.9% from their assets in the first year of retirement if they're retiring this year. That number happens to be up from 3.7% last year if you think it's low, so it's a little bit better. Not only that, but Morningstar ran simulations for a number of portfolios with different allocations, and it's the portfolios with the highest probabilities of success, not running out of money, are those with between 30 and 50% stock exposure. So this, of course, relates back to a study that William Bengen did in the early 1990s, taking hypothetical portfolios, distributing assets from them, and seeing when they run out of money, or trying to make them last for 30 years, as the Morningstar study does. So you have, according to the most recent study, a high probability of success, a high probability of your money lasting 30 years. If you start with a 3.9% distribution, adjusted up for inflation every year, keep between 30 and 50% of your money in stocks, at least initially, and you should have a high probability of not outliving your money, at least for 30 years. We should add also, what does 3.9% mean in dollar terms? Well, you could look at it this way. If you have $1 million saved, 3.9% is $39,000. So that would be your first year's distribution. And then you would adjust that number, $39,000, up for inflation in subsequent years. So you would, next year, let's say in 2026, you would take the CPI for 2025, the Consumer Price Index for 2025, apply it to that $39,000 and adjust your payment. So that's why the study is inflation sensitive, as it should be. It wants to make sure that retirees can keep up with inflation. So that's how these studies work. 3.9% might be a little lower than I heard Bill Bengen himself say recently is his best estimate. He was maybe a little more generous. Morningstar has done a lot of asset class estimates. They've taken them out a long time. I don't think that's completely useful, although they do acknowledge what I think is useful, which is that what happens in the first 10 years of retirement, maybe in the first 5 years, really dictates whether the retirement is successful or not, whether you run out of money or not. If you have bad years in the beginning, that can be bad news for your portfolio lasting a long time. So one of the reasons why the lower stock exposure portfolios have, in Morningstar's opinion, a better chance of lasting longer is because bond yields are at least decent now. The 10-year treasury is around 4%, the yield on it. And stock valuations look expensive. The Shiller PE is 40 or close to 40, as we've discussed on this podcast numerous times in the past. So at least U.S. stock valuations look expensive. So that's one of the reasons why lower stock exposure seems to be warranted, according to the new Morningstar study. I think it's important for investors to take note of that. They're looking at valuations. They're trying to estimate what those valuations mean for future returns, especially for someone distributing assets from their portfolio. I'll put a link to the study in the show notes underneath the video, and you can read it for yourself. I think it's well done overall. I think they've done some pretty good work here. So this is John Kamarianos signing off for Capital Considered. Please click like and subscribe if you like our content. Thank you.
No information on this podcast should be construed as investment, tax, or legal advice. This podcast is not an offer for advisory services or to buy or sell securities. Before making any financial decisions, consult with a qualified professional advisor who can assess your individual needs and circumstances. Past performance is not indicative of future results, and all investments carry risks, including the potential loss of principal. Securities discussed in this podcast may be holdings of the host or his clients.